Good morning and welcome. Patriot Radio News Hour. Joe and Jason on this Thursday after a, crazy huge day on Wall Street yesterday after the Trump victory. Kind of back to reality today, a much calmer market. Gold and silver, big sell-off yesterday, big rally today. Not really surprised. That's kind of how it's been, but I'm hoping that all we had was a profit-taking opportunity, new higher lows set for gold and silver, which is, as you stair-step higher, what you need to have happen. Our toll-free number, 800-951-0592, the website at allamericangold.com. And, of course, we got the Fed today. Everybody's saying another rate cut is coming. We got a rate cut out of the UK today. At the same time, their central bank said, oh, by the way, that UK budget, remember we had a little trauma in the UK debt markets. They're saying, hey, there's going to be more inflation because of all the spending that's going to be happening. I think that's going to be the theme. I really do. I think 2025, the theme will probably be the return of inflation. Here's the good news, though. At least for today, Jason, we have some calm in the U.S. debt markets. The 10-year note got almost to 4.5 yesterday, easing back a little bit. Of course, obviously, we expect the Fed to cut rates by 25 basis points, but at least it's for a brief moment in time. We've got some calm in the debt markets. Yesterday, we did have a good auction, which we thought we would, right, because the rates were a lot higher. We were able to pull that off. But I think today it'll be about the comments from Jay Powell. We had that really bad jobs number yesterday, but then, of course, we had that the really bad number Friday, that huge rally yesterday with on Wall Street. I don't know if that will give the Federal Reserve some pause. The UK today talked about, okay, inflation's coming back. A lot of people anticipate with the Trump presidency, right, we're going to see inflation coming back because, let's face it, businesses are excited, Wall Street's excited, and unfortunately for us, when you spend money and you start creating money out of thin air, you get higher prices.
Well, if the money was being created, responsibly, then there would be no inflation. There's nothing wrong making money, spending money, if the money is created responsibly. If it's backed by gold or, it has some sort of, measure of control, Joe, but that's not what we have. I can imagine, Joe, 20 years ago, you're talking about all the printing that was going on, how crazy it was. It pales in comparison to what's being printed today. It keeps on going, doesn't it, Joe?
You really bring up a great point. It's something where what we're actually doing today, this is, you go back to the financial crisis. We're spending way more money today. Way more. Where's the crisis? Right? When you had the financial crisis, you're like, okay, it's a crisis. We don't like it, but at least we can kind of understand it, right? And then, of course, you throw on Afghanistan on top of that, and, they're okay. We're spending we're spending more now. We're spending more now. COVID, because the policy that they decided to go down meant, okay, we got to spend a lot of money. All right.
A lot.
Right? Okay, that's what you guys decided, right? We have no control over it. You wanted to shut down the economy, right? And you had it, told people you don't go to work. Like, they got to pay their bills, right? So, okay, well, here we go, right? We're going to throw a bunch of money at the pharmacy. We're just going to throw a bunch of money everywhere, which they did. We're spending more money now. How's that fiscally responsible? It's not. But this is what a debt money system does. Like I said yesterday, hey, we had a good auction. It was a 30-year auction. The bid to cover was good, right? Which makes sense, right? Because rates were spiking. Dealers, they took down only about 10% of the auction. That's really good, right? That's really good. That's way better than that 15 to 20% that we've been used to. The problem is, as soon as the auction ended, rates kind of spiked back up again, right? And so it's going to be one of those things, Jason, where I think it's going to be interesting. How much money does the bond market let the government spend? And I say that kind of not recklessly. Here's what's going to happen. The bond market's going to force the Fed to end quantitative tightening and then force the Fed into quantitative easing. That's what's going to happen. Because as it sits right now, no matter what happens, let's just say Wall Street next year, let's be super optimistic. Forget about Goldman Sachs saying, hey, 3%. Let's just say it goes 10. We're going to have less money coming into the coffers because of the big gains this year. Yeah, either way, there's going to be a lot more debt issuance in 2025 than there was in 2024. We'll be back after the break. 800-951-0594 or 0592, sorry. Don't call 94. Don't call 90. They'll be upset. The quick look in here at the markets. The Dow's down 35 points. I mean, after yesterday, big day yesterday. The S&P's up 32, almost at that 6,000. I think they want to see 6,000. I think they're going to, I don't know, maybe they'll say this is close enough, but either way, right next to it here, the NASDAQ up 220, the 10-year note, 436. So when we look at the 10-year, yesterday, it started at about 4.3. Got up to 4.48 right before the Fed here, 4.36. So it really doesn't look like the Treasury market is going to go low. I'll say this. A pause here would be nice. That'd be nice. I mean, this has been a big run. I'm hoping that we get some form of stabilization, at least until we start finding out who's Trump going to put in his cabinet, what type of spending plans are they really talking about. We got to make sure, does the Republicans get I think they do. I think they're going to have the House and the Senate, and we can start getting an idea of how much more money is going to be printed before that 10-year note starts racing again. Right now, oil's up just a little bit, about 20 cents. Gold's up almost $40, taking back about half of yesterday's losses, 26.98 right now on gold. Silver's up 61 cents, so another good day here for silver. Again, taking back about half of yesterday, $31.75. And I'm going to tell you, and I keep telling you, the bond market is sending you a message. Very important message. Warren Buffett is sending a message. By the way, guess what he did yesterday? Was Warren Buffett buy it or sell it yesterday? Oh, he was selling and selling big. Matter of fact, he went even bigger and said, we're not buying any Berkshire Hathaway stock back. They have been buying their own stock. You know, that's what Wall Street, we buy our own stock. Here's already we're buying. This is the first time in, 6 or 7 years that Berkshire Hathaway says we are not buying back our own stock. Why? Are they not buying it back because they think it's going to go higher? That'd be kind of dumb, right? Right? Obviously, what do they think? Hey, why buy our own stock back because we think the stock price is going to fall, and we'll just throw away money. Let's just hold on to it, let it fall, then we'll buy it back later. They're sending you a message. Get more diversified. That's the message that is being sent. Get your gold and silver put away. All of you guys out there, and I know, listen, I get it. I get it. But I'm doing pretty good. I'm going to remind you of the financial crisis. Did you do pretty good then? Did you? Because if you didn't, you may want to do something different this time. Because the bubble's even bigger. You know that. We know that. Listen, that's not rocket science. I'm not saying anything crazy. Right? That's the system they created. I didn't create it. They created it. Boom and bust, boom and bust, boom and bust. Look at what the bond market's doing. Not enough reward for the amount of risk you want us to be taking. Take some risk off the table. Get your gold and silver put away. Get a gold and silver IRA. Take part of your big IRAs. Get it into gold. Get it into silver. You can do it with it penalty-free. And then get some into Y refi. Got to have a minimum of $50,000 on Y refi. But think about this. 10.25% fixed rate of return. Well, that's pretty good. I get 10.25% this year. What do I get next year? 10.25. What do you get the year? 10.25. What about the year? 10.25. 10.25. Not correlated to Wall Street. Didn't care that Donald Trump was the president. Doesn't care that Jay Powell's going to lower rates today. Let me tell you know what else it doesn't care? It doesn't care about some guys putting a bunch of dots on a chart. I can tell you that. Don't care about that either. Check them out. Okay, the election's over. You can breathe now. Check them out. InvestYRefi.com. That's the word invest, the letter Y, REFY.com. Or just call them. 888-Y-REFI-24. 888-973-3924. Jason, we did get some economic data out today. We had jobless claims like we do every Thursday. Not much to report. 221. I think that was up like 4,000 from last week. But 221, boring, right? That doesn't say, okay, that doesn't say rate cut to me. Right? That doesn't. Historically, that wouldn't. Now, I guess, is it up from, 200, 210? Yes. But it's not. Remember, for a while there, we got 240, 250, and then it kind of stopped. Now, there was a concerning piece in this data, continuing claims. So this is, if you did lose your job, are you able to find a new one? And the answer was no. The highest level now since 2021. So you got to go back 3 years to where continuing claims were this high. It's right under 1.9 million, so it's not, Jason, one of those numbers, it's not horrible, right? But it's a point of interest. So the Fed's got a lot to weigh here. We're going to have a new president, right, which means we're going to have a new Treasury Secretary, right? And why do I have a feeling whoever he picks, probably not going to be nearly as, friendly to creating money out of thin air as Janet Yellen. I could be wrong. But Janet Yellen, she's nuts, right? She's used every trick in the book to try to make things look better than what they really are. But then again, though, you did have a crappy jobs number, so we'll see what he has to say. I'm curious today. I actually, for the first time in a long time, I'm not so certain what his comments are going to be. Right? Is he still going to soft shoe, kind of relating that we're going to have more cuts? Maybe, you know what, I'll say this. Does the rise in the debt markets signal to Jay Powell to keep cutting rates? I think it does.
Maybe it depends on how much Powell thinks he's going to be hanging around, or be replaced. If he thinks he's going to be replaced, he may come out with some big comments. If he thinks he's going to hold on to his job a little longer, he may be very quiet. How's that? And if he's very quiet and lowers the rates a half point, then we'll know he had a conversation with Trump. That's what I say. But if he's not getting a good vibe off the new administration, he may come out with some big comments, because he may not have too many more of these meetings to speak anymore, Joe. I don't know if Trump wants to get rid of him or not, but it seems like that might be on the menu.
Yeah, so it'll be, you know what? That's an interesting comment. I don't know. Trump did reappoint Powell to another term. Yeah. Right? I mean, that he did for sure. So it will be interesting. The comments, we'll wait for those. Berkshire Hathaway, Warren Buffett sold another huge chunk of Apple stock, now bringing his sales to date to 600 million shares. It's around 2/3 of his holdings in Apple since the beginning of the year. And you got to remember, Buffett he's not diversified, right? He's a billionaire, right? They don't diversify. They just load up on 4, 5, 6, 7 stocks. That's it. They don't buy. They're not out there. I'm buying the ETF. No, they don't do that. That's not what they do. Additionally, he sold another several $billion worth of Bank of America stock. And like I said, and for the first time since 2018, Berkshire says it will not repurchase any of its own stock for the immediate future. So, when we sit there and we look at what we think maybe where we're headed, I think this is a very, very good place to look. People are talking about why higher rates are going to be problematic, they said, for Apple. And I think for a lot of different reasons. But one of the things that Apple's going to have a problem with higher pricing, right, is, well, you know what? A lot of people need to finance these phones because they're so dang expensive. And of course, competition now from Huawei. They got that new phone coming out, this new chip coming out this month, matter of fact. And then for Bank of America, here's the interesting thing. Because normally with a bank, like, okay, higher interest rates should probably help them in the long run. But something very interesting about why this may not be the case. Remember, Bank of America, just like all the other, and by the way, just write in whatever big bank you'd like to write in on this. See, they've been buying all of these treasuries 5 years ago, 10 years ago, 3 years ago, before the bond market took off. Now, all the banks say, oh, well, we're going to hold these to maturity. So we don't have to count it as a loss, because right now, just Bank of America alone, they've got, Jason, equity of about $200 billion, okay? That's their equity, about $200 billion. They're sitting on $85.7 billion of unrealized losses in treasuries. Okay, which means if, let's just say something bad happened at Bank of America. And Bank of America is like, oh, man, well, gosh, took all these losses. Our equity keeps draining, right? We're down to $100 billion in equity. All of a sudden, you know what? We need to sell some of these treasuries, get our equity back up. We can't hold it to maturity. This is a big problem. So, really, this doesn't count the losses in commercial real estate and all this other stuff. It is a huge piece. It's fine, I guess, if they don't need to sell these treasuries. But, Jason, we know if the bubble bursts, this is going to be a problem. And probably one of the things when you're thinking about Warren Buffett, he's like, yeah, no thanks. Yeah, I'm looking at this, and even think about this. Remember, risk reward. He's got to be looking at it this way, right? Well, if I hold this stock longer, it has the feel that the risk is going to get bigger. What's my reward for taking this bigger risk? And he did the math and said, you know what? I'm not being rewarded. There is no rewarder. I'm not being rewarded enough. And he's hitting the sell button, Jason. That's as easy as I can explain it. The amount of unrealized losses that these banks have. Now, granted, if they can hold it to maturity, okay, right? Okay, you can survive. But what if you can't? And that's where the problem is. Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Higher interest rates taking a bigger bite now out of housing. We heard yesterday, right, applications to purchase homes down 5%. And unfortunately, deals have gone higher since then. Today, Stellantis laying off, looks like now permanently, 1,100 auto workers in Missouri. Nissan saying they're going to lay off 9,000 workers globally as, once again, these higher rates starting to have an effect. Molson Coors, right? So, you know what, come on. Beer, man. Who doesn't drink beer? Their estimates well below what they were expecting. Sales declined 7.8% in the latest quarter, saying the U.S. was challenged with a macroeconomic environment. What does that mean? It means people were just buying less. Actual financial volume down 18%. Wow, that's really big there. So not great news. Again, these are the things that give the Fed reason to go out and cut rates when you're looking at all these consumer stocks just getting hammered, and it looks like, you know, picking up momentum. But then on the other side, you know, and I think this is kind of really ominous of what we're seeing out in the world. Rising mining costs. So we're sitting here thinking about, you know, gosh, gold's $2,700. Silver, now it's been higher. We know that. But it's never averaged this high of a price in a single year. Right? I mean, silver, when you think about, yes, it's had these brief spikes in price. But it hasn't had a year like this, where the price has been high and gone higher all year long. But according to the miners, it's not enough. That the inflation-driven costs are becoming increasingly challenging. Newmont, the world's largest gold producer, get this, their shares fell 15%. Why? Bad earnings. How can you have bad? You're the largest gold producer in the world. Right? Gold's up 40%. Nope. Listen to this, more than 50% rise in all-in sustaining cost. So let's see, gold's up 40%. Sustaining cost up 50%. Jason, right? It's a pretty simple reason when you put these pieces of the puzzle together to say, hey, guess what? The math doesn't work here, right? The math doesn't work. Even with record high gold prices, This is how big inflation is in things, whether it be wages, whether it be fuel, whether it be equipment, whether it be insurance, right? You name it. All of these things, and let's face it, Newmont's like the best of the best. They're a good operator. They've been doing this a long time, and even they can't make it work, Jason. And I think this is what we're seeing in a lot of these companies, that the quote-unquote producers of the world are saying, man, it's getting tough, and we're good operators, and it's still tough.
You're going to see survival of the fittest, aren't you, Joe? When things get tight, that's what happens every time we get into these cycles, and you'll see. And this is what's unfortunate about the way that it's set up. It's set up to feed the biggest companies and destroy the small guys. It's the analogy I have of the peanut butter jar. All the money comes out of the market. You talk about Warren Buffett, right? All that big money is coming out. And all, from the last bust cycle, all that stuff that's stuck to the side of the jar, that's what everybody's been trying to save and earn up. And what the crash cycle is the spatula coming in from the big guys, and they just scoop it all out. And so what you're talking about, Joe, is, look, everything's getting expensive. Everything's getting harder. Do you think the biggest companies care about it getting a little more expensive, getting it tougher? I mean, they care a little bit. But as long as they've got slightly better profits than the smaller guys that they're going to swallow up, the big fish swallow up the small fish, this is the way it's built. I wish it were more competitive, more a fair ground, right, Joe? But that's not what a debt money system is. It's not the way our government runs. It's very much a rigged system, and you got to really, really work hard to survive in this thing, Joe.
Well, just think like yesterday, we had that big day. The 10 richest guys in the world made $64 billion in a single day, right? They all made $4, $5, $6, $7, $8 billion a piece, right? Yesterday alone. Warren Buffett, why is he stockpiling the money? Because of what Newmont was saying. It's the same thing. Buffett knows, hey, there's going to be some really good opportunities, some really good operators. They're going to struggle. Their shares are going to get crushed. And then I'll come in and buy them out. Right? I'll come in and buy them out. And you know what? Here's the great thing. I can get rid of their accounting departments. I can get rid of their, a whole bunch of payroll departments, all this other, put it into my fold here, cut their cost, and turn it back into a winner again. This is what we're seeing. I think we're going to see a lot of this. I think Jason's right. We have the market of the haves and the markets of the have-nots. Look at NVIDIA. It can do no wrong. Intel, the government's like, man, we may have to, we got to figure something out. Intel's the only company in the United States that designs and actually manufactures their own chips. We don't have another company that does it. And guess what? They're a have-not, Jason, right? They're a have-not.
Yeah, unfortunately, you got to be prepared for these down cycles. If you are not ready on a down cycle, you get wiped out. I mean, it's just the way it is. And when you have assets and then things start to crash, but see, something's a little different. What's different this time, Joe, than the 2008 crash is this inflation has gotten so much worse. There was inflation back in 2008. This inflation makes it like a double-edged sword instead of just a single-edged sword, right? Some of these smaller businesses are getting hit from two sides. Costs going up and customers drying up at the same time, Joe.
Now look at Boeing, right? Hey, we settled the strike. The shares keep going down. And then who was it? One of Arrow said, hey, we don't know if we can even survive. And they provide the fuselages for Boeing. Right? They're like, we're out of cash, right? Yeah. The haves and the have-nots. We'll be back. 800-951-0592. Patriot Radio News Hour. Joe and Jason on this Thursday, right? We're going to get a what we believe to be a rate cut announcement coming shortly from Jay Powell, which will move the Fed's funds rate from between 4.5 to 4.75. Statement's going to focus, right? We're talking about this, the language and what will be the gauge to any future rate guidance. The Fed expects the Trump influence on the economy in the outlook. This is going to be a big one. If they talk about that at all, we'll have to wait and see. Of course, Jason and I will bring that to you tomorrow. Bank of America says that he most likely is going to highlight that the Fed will stay in its lane and will react to incoming data instead of commenting on the next administration's policy agenda. Bank of America continues to believe that the Federal Reserve is going to have to continue to cut rates, saying they see a target between 3 and 3.25. So, Jason, that would be what? Another 5, 6 rate cuts, according to Bank of America. Money markets are pricing in 3.5 to 3.75 at the end of 2025. They're saying, Jason, remember now, money markets are big buyers of these treasuries, and the warnings that have come out about the repo facility, how it's emptying out, they're saying that a lot of the gain in the yields has to do with the fact that the repo facility is emptied out, and the Fed still, technically, we're still in quantitative tightening, technically, right? I mean, we're still selling $25 billion worth of treasuries every month. And, of course, they're all saying, hey, the Fed, not only does the Fed need to knock that off, they're probably going to have to become buyers if they have any hope of keeping rates below. Think about this. Could we see a Fed funds rate at 3.5, and yet the 10-year note yielding over 5? And I think that's what the markets are saying. That's what's going to happen unless the Federal Reserve steps in and starts blowing up its balance sheet again.
There's still a lot of that low-rate stuff on the books, right? You got to get rid of as much of that as you can if you're going to keep the rates above zero. So that's the one thing. I've seen a model, Joe, because we thought this is impossible the last year or two, that the Fed won't be going back to zero. We've said how many times, the Fed's not going back to zero. But then I saw a model of what could possibly happen, which lines up with Trump being elected, and the kind of spending that's coming, and how everything has gone short term. The long term borrowing is really just dried up, and it is actually there is a path in where big spending and back to near zero can happen, and obviously it depends on what happens in 2025. So that 3.5, that 3.25, 3.75 you're talking about, Joe, it might be shooting way too high. Believe it or not, they might actually, if things get bad enough next year, I'll take it down to 1. We'll take it down to 1.5. Can you imagine? Because really, if you're going to spend a whole lot of money, you got to get that thing low, right, Joe? How low does the government got want that thing to be if they're going to spend like crazy?
If they're going to do quantitative easing, the theory has always been that you have rates go to zero, right, between 0 and 0.25, right, because you don't want to have to be buying treasuries at these higher yields, right, because it costs more money, right, for the government. So the best thing to do is bring rates as low as possible. Of course, we know how that worked, right? Now, I mean, the Fed itself has over $200 billion of losses on its balance sheet. They just pretend it doesn't exist, right? I guess, they're even better than the banks. They can just pretend that it doesn't exist. It's going to be, I'm going to tell you right now, it's going to be interesting how the bond market responds to things that are happening. Like I said, Bank of England today, they cut rates. And then their Federal Reserve actually commented on their economic policy by saying, hey, this new budget is wildly inflationary, right? So I don't think Powell will do it. They've always tried not to do it. But Jason, I think the bond market will do it for them. Once the bond market figures out, okay, what is this going to look like, I think they'll force the issue.
That sounds reasonable for sure. So Well, I guess it was later today. The rate. We'll see what they're going to do with the first one. Right.
Couple of hours. Yep.
Guy just got to go from where we're at, and then we'll see where the future is. But I never thought 0% or 1% was going to be around for a long time. But there's a scenario next year where things go a certain way, and the spending might just go complete. No. Now what they're saying is, well, we're going to cut spending. I've even heard, well, they're going to pay off the national debt. I've heard all these things. It's like, really? The new administration is going to spend less and cut. And I was like, well, I mean, I know Biden's horrible, but they couldn't even get 1%. They couldn't cut spending 1%, Joe.
No, right.
Can you imagine cutting 10%? Is that even possible? And you got to go way more than 10% if you're going to knock out the deficit and pay debt. They're talking about paying down the debt. Is that even a world we live in anymore? Pay down the debt?
Unless you're cutting Social Security, Medicare, Medicaid, military, you can't cut the interest on the debt. That is what it is. It's actually not possible because just those four things, right, eats up like $6 trillion of the $7 trillion, right? I mean, there's not much left after that. Patriot Radio News Hour. We'll be back after the break. 800-951-0592. Joe and Jason, final segment here on this Thursday. $20 gold pieces, $2,895. Buy 20 or more, $2,875. At 800-951-0592. You got gold, right? 2,700. Matter of fact, December gold, 2,704. As yesterday, nice day of profit taking, a bounce back here. And then we'll see. Anything can happen after the press conference from Jay Powell. I'm gonna say that it's going to be pretty mellow. That's what I think. I don't think there's going to be a lot of fireworks. But Steve Mnuchin was just out. Remember, he was Trump's former Treasury Secretary. He is telling CNBC that tax cuts are a signature part of his program, and they should be easy to pass in Congress, as the Republicans will control the House as well as the Senate. So, again, this means less revenue, more spending, right, from the consumer. That's inflationary. He does say that tariffs do need to be used, especially on China, sanctions on Iran and Russia, and also saying that, as Jason was saying, take on difficult issues and finding ways to cut money. But Jason, again, we kind of know how that goes, right? We get a lot of, in this case, Trump's going to give a lot of tax cuts that usually always cost more than what they say. And then whatever the savings is, it's usually always less than what they say. But for his Mnuchin, by the way, he will not be the Treasury Secretary again. He's not in the running. But again, I think that's probably about right. That's where I see this, and I think this is why you're going to see the bond market not letting up here.
It's going to keep on going, Joe. We're like a broken record. Well, all we can do is sit here and watch and see what's going to happen. Yeah. We do predict things, but as information changes a little bit, that kind of changes with the direction. But it's just the way it is. It's a situation where there's too much spending, there's too much debt, there's too much interest on the debt. We've gone down this path as far as we can. And the only thing the closest thing that I can relate it to is World War II. The debt to GDP in World War II is where we're at now. Now, the biggest difference is the interest on the debt, the amount of debt and the interest payments. So it's not going to be as easy to inflate our way out. But that's no matter what anyone says, no matter what president is in charge, no matter what Fed chief is there, the path that they're going to attempt is to inflate their way out. And, Joe, lower rates, I mean, think about it. Low rates is the best way to try to inflate your way out. You can print a lot more of it if the interest rates are lower. So I wouldn't be surprised if it's a half point today. I wouldn't be surprised. You're probably right. It's probably going to be a quarter point. But why not? Why not? And you just said they want to get it down to 3.5 next year. That's a whole lot of quarter-point reductions. There's going to have to be a 50-point reduction in there somewhere.
You know, I'll say this. It's something where the Fed likes to telegraph. I don't think they've telegraphed 50. I still think it's going to be 25. But you're right. There are scenarios where we could see another 50-point rate cut in the future. We'll have to see how it plays out.